Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. All the comments and subscribers, I greatly appreciate it. This channel is dedicated to the rational cash flow investor, where we value stocks based on their cash flow. We forecast that cash flow into the future for the next 10 years, and we figure out how much we think that company can make and how much we can earn by owning that company for a decade. This week up, we're going to take a look at Facebook. Facebook has been rocked by new guidance put out by the CFO in Q4. The stock is down 40%. Let's see how much cash they make, what they've done in the past, and what under different scenarios in the future could we expect from the stock if we bought it today and held it for a decade. You ready? Let's get to work. Okay, before we dive into Meta platforms or Facebook, I want to remind everybody to read the 10K. Always read the annual report, which is filed with the SEC for the companies in the States, or it's typically placed on the company's website under Investor Relations. It's very, very important for you to read the report every year for every stock that you own. Behind me is Meta Platforms' annual report, and I'd highly suggest you go through and read it. Now, this channel is dedicated to the rational, cash flow hungry investor. That's what we use to value the business, that the underlying intrinsic value. We're not interested in flashing green or red lights. There's no dancing bull or bear symbols that are going to go across this screen. We're just looking at pure facts, and that's what's in this 10K. And what I wanted to point out quickly for you is the type of businesses that Facebook has. Now, they obviously own Facebook, but within Facebook has a number of other apps or way to contact customers. They got dating apps, they've got the marketplace, which is absolutely monstrous. They have groups and they have news feeds and stories, so on and so forth. But they also own Instagram, they own Messenger, WhatsApp, and they have the Reality Labs, which is their VR hardware sales and their virtual reality platform, which I think is going to continue to gain steam over time. Who knows how it performs in the future, but this is the kind of the portfolio they have to work with. And historically, that portfolio has been able to grow tremendously. Recently, however, the CFO has come back and said that the Apple update to the software, to the apps, forcing them to opt in or out of Facebook's tracking, has reduced the growth, is impeded growth. Now, it still sounds to me like he plans to grow. It just sounds like the growth is going to be slowing. He also said that there's a $10 billion hit, that the company will take a $10 billion hit as a result of Apple. Now, I'm unclear what that means, if that's a one-time hit, if that's over a decade, slower growth is going to be the $10 billion hit between a growth curve that goes like this and one that goes like this. That delta is $10 billion. I was a little unclear on that, but we're going to take a look at what a very, very moderate growth case or what a no growth case would look like for Facebook, and how much of a return we could receive potentially, given the fact that the stock is down 40%. Now, before we review Facebook or Meta, let's review the 5 key attributes that we use to track or to judge each company that we review here in the channel. Number 1, top line revenue growth. You got to be able to grow top line revenue. Number 2, earnings growth. We use EBITDA, enterprise level earnings. We're not interested in EPS. That can be manipulated by the number of shares that are outstanding. We need strong free cash flow. Number 4, we need low debt. Debt is less than 3 times debt to EBITDA. We use a leverage ratio that's less than 3 times. And a well-priced stock, well-priced being, if I buy the stock today with a reasonable forecast out in the future, do I think I'm going to beat the stock market? That is our definition of reasonable price. We generally look at a market multiple of EBITDA to enterprise value. I'll get in that later. But those are the 5 key attributes that we use to judge Facebook, or in this case, Meta. Let's go forward and take a look at the historical financial information. Okay, behind me is 9 years of data for Facebook or Meta platforms. Now, this all data is in USD per millions at the end of their fiscal year of December 31st. Now, in 2013, they booked $7.8 billion of top-line revenue. And that number has done nothing but go up for the last 9 years, booking an incredible $117.9 billion of top-line revenue in the fiscal year 2021. That is tremendous. That's a 40% annualized growth rate, an absolute beast. It's very hard to argue with that and that type of performance. And again, that reflects the portfolio that they have collectively has been able to generate that type of growth, along with some acquisitions along the way that they paid cash for, frankly. EBITDA is our level, our measure of earnings, right? This earnings before interest, tax, depreciation, and amortization. It's a metric. It's not intended to be cash flow. It's a metric that's often reported by investment banks, private equity groups, or other companies when they purchase other companies, when they make acquisitions. They'll typically say, hey, we bought this company as a X multiple of EBITDA. The reason we use it because there's lots of market data about how other companies have judged acquisitions on an EBITDA basis. That's why we do it. It's not trying to be a proxy for cash flow. It's a proxy for market richness and valuations. That's why we measure it. And that's grown at 40% or 39%, which is in line with the revenue growth over that time. So margins are constant. The top line is just growing. Next thing we want to do is we want to come up with our enterprise value, our enterprise value of the business. We're going to do that by starting with debt. The enterprise value is simply the debt plus the market cap, which is the stock. Combine that together, that's the value of the business as a whole. It's not just the stock. You have to take into consideration how much debt the business has. Much like if you were to buy a house, you could pay all cash for the house, which most people don't. They typically go to a bank and they finance it. Well, the house value is here, your down payment is this, and the mortgage is here. If you just valued a house on the down payment or the equity you have in the business, that'd be a remarkably different value for the housing market than if you add the mortgage, which is typically substantial, into the price. You combine the two, that's how you get the full price of a company or a stock. And you want to fund a company who has very little debt. That's really what you want. Now, Facebook does just that. Now, it's growing. It's gone from essentially $0 to $14 billion. But if you make $54 billion a year and you have $14 billion in debt, well, it takes you probably 4 months to pay off all debt if you had to, which is a great financial position to be in. Plus, they have excess cash. Now, I define excess cash by pulling the short-term investment lines on the balance sheet, but I can also reach into the checking account if I think that checking account is way too high for the normal bill pay of the business, then I'll add some of that cash in. But just looking at the short-term investments, they have $31 billion of cash sitting on the balance sheet in addition to what's in their checking account, which is a phenomenal position to be in. So again, if I net these two, that's what I mean by net debt. Net these two, that's about $17 billion of excess cash after I pay off debt. Amazing. Market cap is just the stock times the number of outstanding shares. Stock price times outstanding shares. $137 billion to $961 billion, just shy of $1 trillion market cap. Enterprise value, what we're looking for, that's market cap plus debt less cash. Gives me this number. And it's roughly the same as market cap because these two kind of cancel each other out. Now, we want to do a couple more things. We're going to check our leverage ratio, which is here. And it's 0, as I indicated earlier, that all of their cash pays for all the debt. So leverage is 0, which is fantastic. Why? Well, this is exactly why. Here you got a stock, a business that is struggling. And I talk about this all the time in other videos. You got a stock that's struggling. You have something called a capital structure or capital stack. That is basically all the creditors of the business, including us as owners, as common stock owners on the very bottom of the capital stack. And every layer above us is someone else as a creditor or another stock owner that is ahead of us should the company go into receivership or bankruptcy and a judge has to decide who gets to control or own the business. The judge is going to read the paperwork and determine who gets what assets, who gets their money back, who does not. And the common stock owner is always the last in line. But in instances like Facebook, when debt is 0, that means the common stock owner has both the upside of ownership, of owning the company, and the credit position of having no debt in front of them. So if they were to go into the judge and into the bankruptcy, judge would look at Facebook's bills, like would take this cash and all the assets, they'd sell it off. They have a giant stack of cash. The judge would say, okay, creditors, who do I pay with this cash? Well, I'm gonna make sure employees get paid. I wanna make sure the credit card bill get paid, utilities, taxes, right? But then there's no bondholders, or they can get paid out very easily. There's essentially no bondholders, so that the rest of the cash will go to the stock equity holders. However, if there was billions and billions of dollars of stock on here, like other companies we've covered, say Verizon or Coca-Cola or other people who have debt, then that means that if they get in trouble, the common stockholder has to wait to get their cash. Now, that's obviously not likely to happen, but when a stock falls 40%, like it can, like this market is falling, how do you sleep at night? Well, at least I sleep knowing there's no debt in front of me in this business. So even though I own the stock and I've owned it for years and I took a hit because it's down 40%, A, I'm still up because I bought it many years ago, which is awesome. But B, who wants to be down 40%? That's never any good. But what I do know is there's no debt in front of me and I'm not planning to sell the stock now. So the price being offered to me is somewhat fictitious because in the long term, I think the company's gonna be worth more given how much assets they've had and what they've been able to do with it. I'm getting off topic. Let's keep going, but I just wanted to explain the credit position of why it's important not to have too much debt. The last thing, enterprise value EBITDA, that's our relative value metric, right? It's essentially the value of the business divided by how much they make on an annual basis gives me somewhat of a payback period. If the business were trying to generate enough cash to buy itself, that's how many years it would take. And that's come down substantially. It's been high 30s. It's come down to 17. If I were to go and change my number here to the current price, just to see what this looked like, 10 times. So if I move the current price to $200 down from, I'm using 336 from last December, it's now 10 times EBITDA, which is, in my opinion, very cheap for a business of this size. But we'll get there. Okay, that's the revenue, checks the box it's growing, EBITDA checks the box that's going. Let's move forward and go through, cash flow. Okay, so now we know Facebook's growing, made a lot of money, makes a lot of EBITDA money. Well, are those earnings translating into cash, which is ultimately what a company's intrinsic value is based on? All right, so here we go. 2013 to 2021, $4 billion to $57 billion of cash. That's a growth rate of 40% on average compounded annually, which is very similar, almost 1% off. Actually, in fact, exactly 39%, is the same as EBITDA was growing. So that, to me, tells me that the accounting team is taking costs that they're representing on the income statement, and they're representing the cash cost on the income statement properly, because the cash flow, which you can tie out for an auditor, can go to a bank and say, hey bank, how much does Facebook have in cash? And you can track that. The accounting team is representing that on the income statement properly, which I like. Next, CAPEX. CAPEX is how much money they're putting back into the business. They're building offices, they're upgrading the software, they're giving employees new resources to grow. It could be acquisitions, but it's generally not acquisitions. It might be upgrades to acquisitions. But basically, they put very little money every single year back in the business. So if you look at this, is basically 25% of what they generate in 30%. Mental math, I was close. 30% of the cash flow, hard cash money that they make every single year, peel off, go back in the business. That leaves 70% of the money left to equity owners, you and I, because there's no debt. This is the debt table. This is the inflow and outflow of debt. If they borrowed money, it's positive, it's inflow. If they paid down principal money, it's a negative, not interest. Interest is in the income statement, so it's already in here. This is just principal payments. And they have very little debt, so this is very little. And that means that most all of this cash flow flows through to the equity holder. So the question becomes, do we think this cash flow is going to stay the same, go up, or down? That's really what the question is, because we know that the platform itself makes tremendous amount of cash. They have a lot of cash on the balance sheet, and they have very little debt. So they're fortified from a position. Now they're encountering rougher economic conditions going forward, and they have to use their financial position, their historical knowledge, their infrastructure to conquer that position. I think that's something that they're going to work on over time, and it's going to be bumpy. Well, let's finish out the sheet. So then shares have been growing at 2%. I'd like to see that come down. It looks like recently they've been buying back shares. But remember, one of the things we look for is what I call the trifecta. The trifecta is one of the things that we look for any stock. And the trifecta is basically three things. One, earnings growth. It's EBITDA growth. Two, you've got a buying back the shares, reduced share count, which is happening in the recent period here. And number three, market multiple expansion, a stock that's going from 10 times EBITDA to 20 times EBITDA. That might be more challenging in this market, as I think all market multiples are coming down across the board. But if you buy something like Facebook at 10 times, it turns out it's not decelerating, but actually growing and gets credit, goes back to 15 times. That's a 50% increase in the market multiple in all cash. So that's a trifecta that could happen if they turn in a number a year, 2 or 3 from now that's higher than they're forecasting. You could see that market multiple expand again and get that trifecta. But I guess the last point of the trifecta is that's how you get the compounding growth rate that you see. That's because earnings are growing. There's fewer shares outstanding, so you're dividing the earnings by fewer shares, and the market multiple every earning you get gets a higher price assignment to it. That's how that happens. Anyways, I digress. Free cash flow to equity divided by shares gives you per share. They're producing about $13.44 per share of free cash flow price, and then the yield. If I change this to $200, which is where they are right now, it's yielding 6.7% in free cash, assuming no growth or no decline. That's a very, very strong yield for a company that has so many resources as Facebook. Now, if you like what I just went through with cash flow, EBITDA, this Excel sheet, I do teach a course which I'd highly recommend you check out at cashflowinvestingpro.com. I give you this Excel template. I walk you through how to value Apple as a stock, teach you how to read the 10Ks, fill in the sheet, build a forecast, and value companies for yourself. I highly recommend you check it out. It'll serve you for the rest of your life going forward if you can get this process down. Let's take a look, and we'll build a forecast for Facebook and see what we think of this business. Okay, here's our forecast for Facebook or Meta platforms. Really don't know what's going to happen in the future. Now, they've been growing tremendously recently. In fact, let's go take a look and see. If I were to just look at the annual growth rate of EBITDA for a second and compare that to what we're doing now, 38%. Right, so they've been growing strong, 38%, 14, 19. This is amazing, amazing growth. This average is 38% annually. And now I come over here and we're saying we're going to grow at 5%. Now that's a huge, huge haircut. The guidance from the CFO did say significant competition headwinds. The Apple changing the way they do their business is huge. But don't forget, Facebook is a monster company. They have a tremendous amount of influence over the internet. They have a lot of cash, no debt. I think they're going to be able to grind out some growth in the future. I'm throwing 5% there. We'll also do a 0% case just for fun. But I want to see what this company looks like if I put out a forecast that I really think they can achieve over, if you give them 10 years to try to grow on average 5%, it might be chunky, but I think that's doable. So they go from $57 billion to $89 billion of earnings. By the way, inflation alone right now is 7%. So we haven't talked about inflation. We should get to it. But these numbers are nominal numbers. So this is saying in real terms, inflation stayed at if inflation stayed at 7.5%, you'd be losing money. You'd be losing 2% in real terms every year. So I think 5% is doable for them, and I think a $90 billion target for earnings is reasonable out in the future, if not conservative. 15 times for a market multiple, that might be a little rich in this market for a company that's growing at 5%, but we'll leave it there. We'll make it a sensitivity at the end, let you take a look and see how that performs. But at 15 times, 10 times to me seems too small. 15 seems okay. Even if it's growing at 5%, probably a little rich, but I think it's tolerable for right now. That gives you a $1.3 trillion market cap out there. They have no debt, some cash. Market cap basically the same, 1.4 trillion. Divided by the shares outstanding, I'm not assuming that they're buying back any shares or issuing any shares. And I get $478.63 as a price target for Facebook out 10 years. Now, if we do the same thing for free cash flow per share, remember I was in 13 and change last year. I'm growing that at 5% annually, and I get a long-term target of $21.90. I apply a 5% yield to it. Again, that could be slightly higher as a yield, but it's definitely decently high enough for a company that's growing at 5% with no debt and so forth. $438 is the price target for Facebook under the free cash flow method. Okay, so now we have two methods that we valued Facebook on. We have one method, which is the free cash flow method, where you just take all the net free cash flow out in the future, apply a yield to that, and I get a price of $438. And then we have the market multiple method, which is the EBITDA method, which you saw, and I get around $450 is the price target-ish for Facebook out 10 years. Now, the cool thing is I can buy as much stock as I want at $200 a share right now. That, to me, seems like a cheap bargain. Let's see what we get when we drop it into our IRR calculator. So here I'm taking all this free cash flow, which is your percent ownership of the company. You bought it for $200. They may start paying out a dividend. It wouldn't be a bad idea, frankly, if they started doing that. It would put a floor on the stock price because people would know at least I get this yield, this dividend. They're willing to wait for it. But I digress. That's your pro rata share of cash flows. You sell it for $458. That's a 17% IRR right now in a market which is struggling to find good deals like that. I kind of like that. I think that's a nice, strong number. It's certainly de-risked a lot. Let's take this number here, and we'll make it 0. So let's take our growth rate. We'll 0 it. Now our price target here has come down a whole lot. So it's basically trading slightly below value of the 0 growth. But the thing is, it produces such a high yield at that price, you're still making 11% of your money. So even if it doesn't grow, you're going to get some kind of lift. I can bring the market multiple down a little bit. So I'll take this up to, say, 6.5. And we'll take this down to 10, where it's trading currently. We'll see what this does. So I've lowered the market multiple. There you go. I've lowered the multiple to 10, so no market multiple expansion. I've increased the yield to roughly what it is now, 6. I think yesterday it was yielding 6.7. And I can buy it for $2. So this is basically a bond, right? So you bought something, you buy a bond at par, and you redeem it at par in the end, so you get the same principal money back. And only thing you get is the cash flow stream, which is here, and that stream is 6%. Or 6.7, and you're going to get about a 7%, 8% yield with this cash flow over time. That's the IRR on that money. So I think that's kind of the low end of the range. I'll back this stuff out so I can put it back to where I had it. So I think you're looking at an 8% range if you get 0 growth and the market multiples stay where they are. You make 8% of your money. If the market multiples expand a little bit because there is some growth, even at 5%, you're looking at 17%. If they, for some reason, come out, say a couple years from now, and turns out that the VR sets are really selling well, or they go into gaming hard, or something, they do something else with this cash that turns out to be a growth pipeline for them, then that upside might come back, and you might see a higher multiple. Last thing I'll give you is this just distribution. If everything stays the same with this current forecast that's in here, so that's the 15 times market multiple, it's the 5% annual growth rate. I'm at $200 a share at 17% return. As the share price falls, it gets more and more attractive. As it increases, obviously, it gets lower and lower in a return. If you like what I do here, I do have one-pagers on my website, the Cash Flow Club. So for a monthly fee, I kick out more stock reviews than I can do here on weekly, and you get exactly this. It's 10-year outlook of historical numbers. It's a guidance for cash flow and EBITDA, a little chart over the last life of the company, and a quick write-up. And the 5 key factors are highlighted right there for you. So you can quickly assess. You kind of stack these up over time, and you can quickly assess, hey, when the market drops like it's dropping right now, you have a stack of these. Which ones do you go to right away and dust off and try to find? That's very, very handy. But also check out cashflowinvestingpro.com, where I do teach a course, and I go through how to value business, how to buy stocks. I give you all the tools you need to do, and I train you as an analyst. So you can do this for yourself, right? There's tens of thousands of stocks across the world. Nobody can possibly review all of them. And this is a stock picker's market currently. Indexing is dying. You're going to have to go find the one company or the 20 companies that you want to own in your portfolio that will change the course of your financial future. And to do that, you're going to need to be able to analyze stocks. So check out cashflowinvestingpro.com. Let's recap the 5 key factors for Facebook or Meta platforms. Number 1, top line revenue growth. Yes, it's growing. Earnings growth. Yeah, it's growing. Guidance is weak, but at weak growth, I still think they're going to grow. Strong free cash flow, absolutely. Low debt, yeah, this debt is 0. And well priced, yes, I think the stock is well priced because with a moderate amount of growth, very conservative amount of growth, 5%, and a small increase in the market multiple, you can get a nearly double-digit return. Excuse me, it is double-digit. Market beating, 17% is beating the S&P at 10% by 70%. So that I think there's a chance that you can beat the stock market with this one. So I'm going to give it a good. And I will say that you should caution the amount of cash you put into the market. I think the market's going to come down for the next 3, 4, 6 months as the Feds increase, as Feds pull money out of the economy. That's going to mean bond prices are going to go up. As bond prices or bond yields rise, money is going to come out of the stock market and go into bonds. All of the pension funds that need 5-6% to meet their obligations, they've been chasing yield in the stock market. As the bond prices rise, that money is going to come out of the stock market, go back into the bond funds, and that's going to mean market multiples are going to come down across the industry. So if you have a stock that was only trading at a market multiple, say GameStop as a great example, right? Terrible cash flows, only trading on a market multiple basis. When the market multiple collapses, there's nothing there to support it. Facebook, on the other hand, has absolutely strong cash flow. The market multiple might still come down because the stock price is somewhat of a random number generator, but that doesn't mean the underlying value of Facebook has necessarily changed if the forecast doesn't change. So I still think there's a lot of value here in the stock market, and you should be selective and cautious about as you put money in over this trough. It might last several years. So take your time, buy well, don't be in a rush, and have some fun picking stocks. My name is Cameron Stewart. Check out the videos that are coming up next. Great cash flow videos. Take a look at those. Let me know what you think. Please hit the subscribe button if you haven't already, and throw a comment down below for a like. I really appreciate it. Thank you very much for watching my review of Facebook. Take care. Bye-bye.